Welcome to the very first episode of the Finance Operators. My name is Drew Fallon. I'm currently the co-founder and CEO of Iris Finance, where we help these CPG brands kind of automate and drive better decisions through their financial planning and analysis. And prior to that, I sat in the CFO and COO seat at a beauty brand called Mad Rabbit. So I've been sort of in on and around the industry for about a decade now. How about you, Mehtab?
Yeah, my name is Mehtab. I'm the co-founder of Carta Ventures. We've been investing in buying and selling all sorts of D2C brands. There's always a retail component too, kind of up to 100 million in revenue, up to about closer to 75-ish is kind of where we like to play. Distressed or profitable, it doesn't matter. We do a variety of things, equity, debt, structured equity. So that's what we do. And I've been running D2C brands since I was 19 or 20, and I'm 31 now. So too long, over 10 years. I'm old. I'm an old man. In this episode, we're going to cover a bunch of M&A deals that we've recently done in the space, mostly focused on food and bev. We're going to jump into a case study. We're going to talk about Hims, probably one of the best, coolest D2C brands to exist in a very long time. And we're going to wrap it up with some tactical finance advice, my favorite thing, focused on how you can really understand what lenders are charging you and how not to get rugged.
Did you say Olaplex? We're going to cover Olaplex. We got to cover Olaplex.
That's true. Olaplex, everyone's favorite beauty brand. All right, let's jump into it. Drew, you have some trending stories for us today, some M&A?
I do. I want to talk about the M&A landscape for the industry. So we've seen, in my opinion, a handful of very, very landmark deals. So shout out Spindrift, I think $650 million to Gryphon, and that was announced at the end of 25, ended up happening not that long ago, closing. And then Alani Nu, I think a week or two ago, was a biggie. So you got like $1.08 there. Versace is going to get bought by Prada, $1.6 billion. Simple Mills went earlier this year, nearly $800 million, all cash deal. I think, you combine sort of like this like recent M&A activity with sort of an uncertain, or, I think the consensus view right now is that there's going to be like a slowing of growth in the back half of the year. So like, how do we, Mehtab, as CPG operators, like how do we reconcile the idea that like, okay, rates are on an overall sort of downtrend over the last 12 or 18 months. There seems to be some macro uncertainty, but at the same time, things are getting snapped up, right? And good companies are getting sold. So like, I keep going back and forth. I'm like, is M&A back? If I had to bet one way or the other, I'm probably a contrarian, but like you as somebody who is actively looking at deal flow in the space, like what does it look like from the buyer perspective? Like, are we back or are we not back?
Yeah, I think a lot of the really crazy deals that were getting done in 2020 and 2021 are not happening. So, for example, if something's distressed, you're not seeing it go for like some weirdly, absurdly good multiple. Like we're looking at one retailer right now that went from 110 million in revenue down to 70 million. Another one that went from about 70 million down to, I think, 30 million. And there are no real bidders for those companies. At the same time, you're seeing companies like Versace, which are obviously way upstream. That's still sold for a healthy multiple. So I think it depends on what specific part of consumer you're looking at. So there's still a lot of bullishness around luxury, right?
Yeah, and I don't even understand that either, because I did a little bit of research on like Versace for instance. I mean, it must just all be goodwill in the brand, because like I think the number was that they've lost 62 million over the last year or so. I mean, I made like a little chart that I threw up on LinkedIn where it was like they got bought in 2019. I believe the purchase price was 1.8 billion, which inflation adjusted is probably actually more than the purchase. It's already more in 2019 dollars, but significantly more than sort of the resale price here. Like, is there anything in your experience that like would give a brand like that kind of like command in like a multiple, like even if they suck, like, which financially they do suck? Like, what about the company, like? And is it just the positioning? Like, what about them allows them to command that kind of like a deal? It's crazy to me.
I think it's the positioning and the belief that the asset can be run much better. So the acquirer actually said, I have here in my notes here, they expect revenues to keep dropping down to 810 million in 2025, but they expect to get it to break even on an operating basis, if that makes sense. So obviously they believe that the company is not well run. And I know the family was still quite involved, or they had a significant equity stake, and they ended up rolling a chunk of that into the new deal. So in that case, I think they just believe that there's a lot of low-hanging fruit, that the company can be run better. And if you do look at luxury comps, there's still some some conglomerates are still doing well. Like Richemont did not do well, but LVMH is still doing very well. So, and Richemont is more diversified. I think they have more going on in jewelry, et cetera, outside of just apparel.
Yeah, so I guess it's kind of like the staying power of the brand like can help you command that kind of a multiple. Then like on the other flip side of the coin, like you also have like an Alani Nu type acquisition where I think the sales multiple on Alani Nu might actually, well, it's 2.8 versus 2.0, I believe, for Versace if they're going to do 800 to forward. But like essentially, a company that was at like 600 million in revenue going for 1.8 and sort of like the top line purchase price. What I do want to talk about, I kind of want to get your feel on like they're 12x fully synergized
I
EBITDA.
saw that.
So I did this.
Yeah.
This was awesome, and I love that it was UBS that advised on this transaction. I thought that was hilarious. So basically, the numbers
Why did you think it was funny, Drew?
Just because like it wasn't like J.P. Morgan or like Goldman, and it's like a 1.8
That's the
billion.
inner investment banker coming out of you.
Well, it's just
They're
like
not a
it's
BB.
kind of,
Is that what you're thinking in your head?
yeah. I mean, basically, because like I don't think that J.P. Morgan would have stamped their name on this whole 12x fully synergized thing. Like if you look at it, the numbers were 69 million in, I believe, net income. And I'm not looking at this, so I might be misremembering, but 69 million in net income. I think they adjusted that EBITDA to like 86 million or something. And then they threw an extra 50.00 million of pro forma synergies onto the number so it came out to be like 130 million adjusted or something. How do we think about Mehtab like in an M&A process, like adjusted EBITDA?
Yeah, I mean, we were just looking at a retailer the other day that it's one that I mentioned earlier that went from 110 million down to 70. And I think they'll do like 50 this year. They were marketing themselves as EBITDA positive, like 2.4 million in adjusted EBITDA, but they lost $7 or $8 million in cash, right? And you want to do your own adjustments and kind of see what it comes out to. And it's just a way for investment bankers to try and push what they can. And sometimes it works, sometimes it doesn't work.
How does like the tolerance for the breadth of those adjustments change like with the M&A cycle, right? Like is there like a pattern of like, okay, like M&A is hot, so like that's adjusted versus like M&A is dry, so it's like you're stringent about the adjustments. Like like as a buyer, like as we think about like the M&A landscape going forward for this year, like do you think that there is going to be like a little bit of like flexibility around that kind of a narrative? Like I thought this Alani Nu deal was such a landmark deal for just a couple of reasons, including this, because like if we're gonna publish 12x EBITDA, like that's like pretty desperate, right? I mean, like it's fairly obvious. Like, so yeah, curious your take sort of on that direction.
Yeah, there's the adjusted EBITDA side, then obviously there's other components too, right? Like the deal was not all cash for Alani Nu. I believe it was a mix of stock. So I think it just depends, again, on the category, what the structure is of the deal, and all these things kind of come together, right? It's you take from one area, you might give in another area. It just depends on who's acquiring the business and what they're looking to do.
You know what I think is actually another sort of interesting topic is structure, right? So like as we're talking about M&A and what we think is going to happen, like I still haven't gotten really your answer. Are we back or not back?
I think we're kind of coming back to more normal M&A levels and multiples. I don't think things are necessarily really cheap, but you are seeing more of the absurd stuff chopped off the top. So, for example, this retailer that we're looking at, before, I wouldn't have been surprised if someone came in and just bought them for the revenue to bolt on and said, yeah, there'll be synergies, don't worry. It'll be clean revenue. We'll get some counter seasonal revenue, et cetera. But now I don't think anyone's really going to bid. I think we might have one or two other bidders coming in, but they'll be reasonable. They won't be crazy. They won't be paying like $30 million or something for something that's, hemorrhaging money and maybe only does 50 million top line.
Okay, so let's just like ride with the narrative that like, okay, like this is at least an uptrend for M&A. I think it's important, and I want sort of the audience to understand a little bit more about structure. So like it can be extraordinarily convoluted, and like you can see, okay, like this company sold for $1 billion, and it's like, what does that mean, right? So like in the case of like the Alani Nu, like it's actually pretty clear what it means because they break it down. They're a public company, but oftentimes you see, company X was bought by private equity, or company Y was like sold to this like random fund you've never heard of. So like, tell me like a little bit about the sort of random run of the mill headline deal. Company X is acquired, you know, like
Right.
not a big, not a small one. Like, what do you think that actually looks like? Because like if the number's 50 million, like almost never is the cap table just like walking away with $50 million, right? So
No,
like,
no,
yeah,
no.
yeah.
I'd say like for a company in the lower middle market, like you described, 50 million, let's say even up to like 250, 300 million ish. Typically, you'll see deferred compensation make up anywhere from 20 to 30% of the transaction, maybe even 40%, depending on how hot the market is. And what do I mean by deferred compensation? I'm talking about earnouts or anything else that's kind of performance based, or there'll be a seller's note in there that kind of lets them bridge what they need. And the big
Well,
determining
here,
fact,
hold on,
yeah,
stop for the audience. Tell me really quickly, just what is a seller note?
a seller note is just literally debt. So you might buy my company for, let's use easy numbers, $10 million. I say that I'll provide you financing for $2 million of that, and you can pay me just like any normal debt. I'll sit subordinate to the main lender that's doing the deal. And maybe for more color, your typical transaction right now is probably around 30% debt. So if you're acquiring something that's healthy, profitable, enterprise value is 100 million, you're probably financing about 30 million of that with debt. And then you can layer the seller's note on top of that, and it'll sit subordinate to the main lender.
Okay, so Mehtab, I am a $75 million body care brand. I sell mostly soft good consumables. I have reached $75 million in revenue. I'm doing about let's say $10 million of EBITDA. It's 2025. I'm feeling pretty good about, you know, M&A in the consumer sector over the course of the last quarter.
Right.
I am reaching a critical mass of scale, from a revenue perspective at least. And you're my banker. Okay. So let's say I just got like an inbound offer. What does that offer start to look like from the very beginning versus like what are we pushing it for? And like how can we change or negotiate the structure into a place where, let's say they offered, you know, whatever million amount of dollars, like how close can I get to all cash of that versus like what you said, I don't know, 20 or 40% basically of
Right.
deferred compensation. So like walk me through what you think that's gonna look like for this year as those, you know, as those founders start to maybe kind of see some of that stuff.
Yeah, I think you'd start to see offers trickle in at kind of 10x, 12x. And that would include a lot of deferred compensation. Depends on what growth was, depends on what specific subcategory you're in, the percentage of sales, how much is subscription. Obviously, the higher quality your revenue is, that's the biggest lever, right? An extreme example would be comparing something like sticky B2B SaaS to consumer, but not subscription consumer, right? That's very low quality. So in this case, I'd expect it to start kind of 10 to 12x, and then you can push that up or down depending on those factors.
And how do we start at 10x? Like, is it because we've reached that revenue scale?
Yeah, it's more about EBITDA. Yeah, I think it's more about EBITDA, and that would be on the low side. Like I'd really expect something like that to transact closer to kind of 12 to 15x, depending on how liberal, again, like all those other factors, then how liberal I want to be with deferred compensation, if I'm okay with rolling equity, if I want to get involved with transaction post, if I'm okay with, like I said, rolling a lot of my compensation and even having that compensation be tied to the performance of the asset post close via earnout, right?
So let's say we're doing 10 million of EBITDA and there's a 10x transaction. Let's just call it 100 million. Let's make it nice round numbers. What is that? What am I pushing for? I'm trying to sell my body care brand, Mehtab. What am I comfortable with, structure wise?
Structure wise, I think most investment bankers will coach you to be okay with taking kind of 20 to 30%, I think would be acceptable as far as deferred compensation. Again, just depends on what your comfort level is with an earnout versus seller's note or some sort of other tool that they come up with, and the reputation of whoever is buying you, right? Some strategics are, I won't say who they are, but some private equity firms specifically are really bad about paying earnouts, and they will try to screw you, and they'll try to play legal battles and slow play that because it effectively increases their internal rate of return, right? If I don't have to pay you and it only costs me, say, 100 grand in legal bills, but I don't have to pay you $10 million that you're owed for another extra year by just deferring in court, maybe I juice my IRR and it looks way better, right? That's all they really care about at the end of the day. And there's lots of these guys that will do the stuff like that. There's one firm that's really famous for doing a lot of lower middle market deals. Their fund is more middle market size, but they just blast out offers. They'll renege at the last moment, and they will do stuff like that just to drag out earnouts, juice the IRR, et cetera. So you have to be careful who you're selling to. I do think there's like a lot of reputational weight to whoever's acquiring you. I think you should take a lower offer if they have a really good reputation, if you like them a lot, if you believe in what they're doing and you respect them. So Drew, what do you think the implications are of all these M&A transactions getting done, seeing multiples kind of go up? What do you think it means for the space? What does it mean for me if I'm running a brand doing 30 to 50 million a year in revenue.
My personal opinion, and I think this is just like really evident in the Alani Nu deal, was like, if you look at the top 10 market share brands, the brands that have the top 10 market share, like Alani Nu is the only one left besides like NOS. Like, like Ghost is like very modern, and like, KDP is like obviously building like a very formidable energy portfolio. But like, I can't imagine like if I'm, a big strategic and that's like clearly the hottest category like in beverage, like even like Red Bull, for example. Like I don't know that Red Bull is like very acquisitive and like they're the leader by like a literal mile. So it's maybe a bad example, but like there's nothing good left for you to buy. Right. And like everything's gone. Like Monster bought Bang, Keurig bought Ghost, Celsius now bought Alani Nu.
So Drew, do you know how Monster ended up acquiring Bang Energy?
It was out of bankruptcy, I think, but I don't know like anything sort of beyond that.
Okay, so you don't know how they ended up in bankruptcy, right?
No.
Okay.
Tell me.
So are you familiar with the crazy founder? He has the gold necklace, the giant bee.
Yeah,
Bang.
yeah, the guy's nuts.
Okay,
Yeah.
the guy's nuts. They get sued for their super creatine claim by Monster. They lose. It's like a $500 million judgment. I may be wrong. I think it's something like that. Forces them into a really bad position with cash. At the same time, they botched a distribution thing they had going with Pepsi. I forget what that was. Puts them in a really bad position. Monster swoops in and buys them out of bankruptcy.
That is capitalism literally at its finest. You said you didn't know anything about food and beverage. I totally missed that. That's insane. They were the OG. Like Bang was like energy drinks like before it was energy drinks. Like they should have been like a public company basically. They were Celsius like before Celsius was even cool.
So how do all these transactions affect your average operator running a business doing 30 to 50 million a year?
Yeah, so like to give you context, like the average company on Iris right now, I think does $34 million of annual revenue. So it's pretty low. There's a lot that are way higher than that. There's a lot that are way lower than that. But essentially, like what I think it's important to understand is that like these transactions mean nothing for you if you're doing $30 million a year in revenue, right? I mean, it might give you, some confidence in your ability to become acquired, but like you have to get, based off my conversations with bankers and sort of like what I've seen firsthand, like 50 million of top line is like where you start to even like maybe become like a headline type M&A deal.
What it does do for you is it makes it much easier to raise capital, whether that's debt or equity, because you can point to a successful transaction if these transactions are being done at a larger and larger scale. Like it's not good if they're going down because that it kind of shrinks your max outcome. But if you're trying to raise money on the equity side, you can point to that and say, look, they had a $500 million outcome, so we can raise with like kind of the end goal being that $500 million, right?
Yeah.
And same with the debt side, right? There's a story there. Debt to an extent is collateralized by the value of the equity in the brand. So
I agree.
It kind of helps you there.
Entirely agree. From the minority equity perspective. So like the reason that I am so bullish on like M&A this year is because of these deals. I don't think it helps the $30 million a year brand get bought. But I do think that like what you're seeing is like a very important tranche of the, overall capital stack sort of get unlocked from the standpoint of like, okay, like strategics are buying. That means private equity can get more comfort buying. That means that venture capital can get more comfort buying. So I totally agree with, and it might not be that linear, but like I totally agree from the minority equity side. Okay, fair enough. You're right.
And even lenders, right? Like it makes it so much, they feel better about it. I know a lot of lenders that actually paused consumer in 2022. There are a few that we'd worked with on a regular basis. They're like, oh, we're overweight on consumer. We're not touching it now for the next year. I was like, holy, okay.
Yeah. So what does it mean? Yes, I let me be more specific. It means nothing for you if you want to sell your business today. It means everything for you if you're looking to raise minority capital and you want to take it the whole way. I think, what comes with minority capital is obviously a lot of terms and structure itself. And so that, may not always sort of work out in your favor. But as far as like, hey, like Alani Nu just sold, like I'm a startup energy drink, like I'm going to go sell my business. I would beg founders not to kind of think about it like that. I think, yeah, maybe like a decent way to say it is like it turns on the light at the end of the tunnel. I think for a lot of these folks, we'll kind of see how it all plays out this year. But yeah, I mean, there's reason to be optimistic. If I'm a brand owner doing 40 million, I'm not quite counting my chips.
No, for sure.
Yeah.
Okay, now let's jump into Olaplex, which is going to be our fun little case study here. I haven't looked at the brand since 2022, maybe 2023. I remember EBITDA margin being disgusting. I remember growth being disgusting in the best way
Insane.
possible. What does that look like now? What's going on with them?
Okay, so Olaplex, like this is the craziest. This is the craziest thing I've ever seen. Like everybody kind of, well, maybe not everybody. It depends how closely you follow public consumer equities, but like basically, Olaplex was like the craziest, like profitable business you've ever seen in your life.
Was the EBITDA
Maybe
margin like 40% or something?
way higher, like
Crazy.
60 plus. Yeah.
Good
So
Lord.
so EBIT in 4Q21 was 59%. And that was like on gross margins of 79%. So you literally had like total OpEx of like 20%, basically, including marketing. And I say it like that because they don't break out their marketing. But essentially, this is the story with Olaplex. They started
Oh,
in
sorry. And
2014.
maybe it'd be helpful if we just explained like what's normal for a company like that, like a beauty company.
I mean, you're literally best in class at 25%.
I'd agree with that. Yeah, I think like
Yeah.
15 on the low side, 25 is like very good for beauty.
Yeah. I mean, if you're pushing 30, like nobody's going to give you like a ton of like credit for that anyways, like
Yeah.
you're just means you're not running probably
Yeah,
like
you're not spending enough.
you're not spending enough. So this, yeah, I agree. I think of the sweet spot as anywhere from 15 to 25. 25 is kind of the high end. So to be doing 60% in EBIT margins,
At scale.
growing at scale, $160 million a quarter,
Mhm.
growing literally 58% year over year. So this is I'm looking at 1Q22, 58% year over year. So essentially Olaplex, if you're not familiar, they invented prestige hair care effectively. The company started in 2014. I think it was a husband and wife kind of duo. The reason that they got like so much notoriety so quickly in sort of like the salon in prestige space, I think Kim Kardashian started using it, and so they literally just blew up. By the time they got bought by private equity in 2019, 5 years after they started, they were doing 100 million in sales. So Advent International, middle market PE fund, maybe a little upper market at that point, PE fund buys them out. They're doing 100 million. I think the deal. There's not like a ton of places you can find the deal, but I've sort of read like the 500 million range, which I think would track.
That sounds
Um,
right.
yeah. So basically, they go and they IPO 2 years later. 2 years later, 12 billion. They get up to $18 billion in market cap. Shortly after the debut. Because, like you said, like think about it this way. Okay, so like the rule of 40. Do you know
Right.
what the rule of 40
Yep.
is?
Yep.
Rule of 40 is that your growth rate and your EBITDA margin should add up to at least 40. This is commonly used in software. I don't hear many people talk about it in any other category. So
But you know what? I would say rule of 40 is pretty fair for consumer too. I'd say like that
Okay.
sounds about right.
Sure. Let's apply it to here because this should be the rule of 100 because they literally were growing 58% and this is 1Q22, 58% year over year revenue growth, 58% EBIT margin. So you're talking about the rule of 40, except this is the rule of 116. Like they're outpacing the best in class software businesses by triple. And so and they're only doing, several hundred million a year. I mean, only for a company that's valued at 18 billion. And then like somehow, this is what I was kind of digging into, the wheels just completely fell off. Okay. So, in 4Q21 was the peak of gross margin at 79.4%. They reported earnings, I think literally yesterday, 66%. So that's 13 points gone of gross margin.
What do you
Yeah.
think happened?
It seems to basically come down to competitive pressures. So Olaplex kind of had this like Kim Kardashian moment. It was all the rage in the salons, and what I want to use this Mehtab to talk about is like the implications of like competitive pressure just in general in consumer, because the fact that you can go from an $18 billion, 118 rule of 40 publicly traded powerhouse to 8 quarters later a dog effectively is insane to me, right? And it's like it shouldn't be a public company is kind of like where I keep coming back to. It's like this is really a business that's doing 400 plus million in sales. They had 20% EBIT margins as recently as 3Q24, right? So 4Q24 EBIT was 3%, so that's 56 points lower than 4Q21. 56 points in like a handful of years, shaved, gone, all because all because at the end of the day, K18 and Redken just ate their lunch basically. And the craziest part of all of this, I think, as sort of a D2C native, is that their D2C channel is the only channel that's actually grown since their IPO. So when they IPO'd, they were doing around 38 million, and now they're doing about 40 million. So per quarter. Um, so tell me how this is even possible. Like how does this happen? And how do you stay ahead of it? Like this is the biggest fall from grace probably in the history of consumer products.
I feel like they kind of started pushed into a white space that didn't exist before. And over time, like you said, competitors came into the space and compressed margins. And I think that's really common. It feels like, you can tell me what you think, but it feels like the only way to stay ahead of that is new product development and hoping that the product can be as big, if that makes sense. I think in their case, it's really hard because that first product line was just a monster, right? It's unlikely you'll be able to replicate that. I think it's really hard. A lot of it's luck, a lot of it's timing, et cetera. That's how we think of it internally is, oh, cool, this company had this hero product it scaled off of. Maybe there's ancillary products you can launch, but can you replicate that success of the hero product? Maybe. It depends how far you can scale, right? Like lots of great consumer brands have scaled off of one hero product to crazy revenues. But if you're in something with a smaller TAM, it gets harder, right? Or in this case, a lot of competitors could encroach on the same approach, the same USPs, et cetera. And is that like how you think of it too, or?
It's just hard to stay with the times. Like Allbirds is like another fantastic example. Like it's nowhere near the sort of like value destruction as Olaplex. But it's like, they were at one point the hottest thing ever. And I guess like it's as simple as like consumers just move on. And like I see this a lot when I, talk with some of our companies with Iris, and they'll ask me for advice on raising capital. Like some of them are growing extremely quickly, like too quickly, right?
So at Olaplex, one of the big drivers of their EBITDA margin kind of coming down and compressing over time, you mentioned was on the gross margin side and promotions, right?
Yeah, I mean, I've sort of referred this in a couple different ways, but basically, like the growth margin spiral of death is kind of the way that I would describe this, and it's actually very common in like apparel, just because supply chains are so difficult and sort of staying on top of the trends are difficult. But you see it here in Olaplex, and really it can translate to any business model, and kind of the way that the gross margin spiral of death goes is you start discounting because you're not moving product, you're not growing as much as you used to, and then your gross margin contracts because you're discounting. And then you have less gross profit to actually reinvest in customer acquisition. And so your inventory then starts to move slower because of that. But you then end up discounting more because you're trying to move that product. And so you end up like seeing just like this, you can fall off a cliff with this kind of mistake. And I think, as consumer brands, like our number one priority, honestly, as CFOs should be protecting gross margin basically at all costs. And I can't imagine that there's not like a better way to move product or incentivize customers without just completely trashing your gross margin.
Right. Yeah. One of the ways we like to do that is using an app called Fondue, which is one of our sponsors here. And it helps us keep promotions really fresh, but more importantly, it helps you maintain really, really healthy gross margins. What it is it's a cashback promotion. It lets you run that easily. If you're on Shopify, it's super easy to install and get running. I think it's totally worth at least a test. For most brands, it'll give you something to email about that isn't just a flat percentage off or some sort of BOGO offer. It's another tool in the toolkit. The great thing is a lot of people who end up using the cashback, customers, they will not claim it. And as a result, you end up with more margin. And again, I know True Classics used it, Ridge has used it. It's totally worth the test. And it's a nice way to keep things fresh, juice tough performance, and maintain healthier margins.
And it makes sense that those types of brands would use it because I believe both of those companies are like first order profitable, right? And so like you're not kind of seeing people dip into the red, and it sounds like a pretty decent way to just kind of get people sort of over the line without losing money or seeing contribution margin contraction. Because like how does it look to go? Like is it easy to set up, or like what is it, like a pop up? Like what's kind of like the actual process of using something like Fondue?
Yeah, if you're on Shopify, it's a really, really quick install. Won't take very long. And I would definitely recommend doing things like running specific ads on top and the pop-up for sure. I would test either flat percentage for a bidge or cash for a bidge and see what performs best. And again, that's where you get the tough performance, the juice, something fresh. You're breaking up that feed nicely. And on the back end, you're maintaining healthier margins because only a certain percentage of your customers will collect. So, um,
Yeah. And I guess you kind of avoid like the whole idea of like coupon codes getting leaked as well, right? Because
oh
like if you
yeah,
end up just like yeah, there's like I remember like we used to like send a ton of emails and then we would see we'd have to end up using one of those other apps to basically clean it up kind of a thing.
right.
So
And you get slammed by
yeah.
like Honey, Retail Me Not, et cetera. You end up on all those sites and you get destroyed.
And that's how your gross margin actually sort of like falls out of your control, right? And people that do it with like affiliates and whatever else, it kind of gets out of your hands.
But it's just leaky. It's like there's no point in it's just kind of stupid. So yeah, I mean, they're one of our sponsors. Make sure you mention that you heard about them on this podcast, the esteemed finance operators. And anything else to add to that, Drew?
No, I think that's it. If you're a CFO or an operator that's looking to protect your gross margin, I mean, I think this is like a really intuitive way to do it.
Great. Yeah. Get in there, test it out, juice those margins, and then let us know how it went.
Another good example is actually like Hero Cosmetics, right? So Hero Cosmetics
Oh, I love
grew to
them.
like, yeah, awesome business. One of the best beauty acquisitions
Can
of
you
the last
explain what it
decade.
is?
Hero Cosmetics it's just like the acne patches. Like I don't think they were first by any stretch. Like I think Zitstica and Peace Out were like way before that, but Hero just nailed it in retail. Took some money from Trevor at Aria Growth, I think like 30 million or something in like 2020, maybe 29. I don't even remember. And they sold to Church and Dwight for $630 million like 2 years later. So they absolutely crushed it. But the report said that they were doing 100 million in revenue. And like, I literally think like 40 million in EBITDA or something. And so it kind of, begs the question, like, is that not like $1 billion company? And the answer that I sort of gathered from my conversations around the street is like, they were growing so fast that they actually caught a discount. Right.
Wow.
And so, I see it with, it's happened in real M&A. I see it with Iris people and stuff. And I guess the market here, like Olaplex was growing so fast and doing so well that in 21, the market just like didn't stop to think like, how sustainable is this? When the answer to your point is like, not really at all. I think it just ultimately comes down to like fad risk is kind of like the number one way to say it. And like in the age
Yeah,
of
that's exactly
TikTok,
what we look at too. Like we were just looking at a deal for a company selling those tubs for cold plunges. Revenue's been tanking and they're trying to figure it out. I pulled up Google Trend and you could see it just falling off, right? Like the consumer trend, like you were saying. I mean, how many people really want to pay a lot of money for a cold plunge tub? Like probably not that many. And it is like a bit of a fad.
totally. And like, I track like M&A in our category like fairly, closely. And like one trend that really jumped out to me, the average. Here, I'll do it right now. So like I've tracked, I guess, I don't know, like 100 like deals that I care about over the last like 2 or 3 years. The average time in business is 30 years of a target that's been acquired. So like these buyers, like they really want to see staying power. And like Olaplex, like they started in 2014. So like you would think like, almost a decade later, like that staying power was proven. I mean, if anything, they were accelerating. So like what's, when you say like you look at it, like what's your process for like trying to understand whether or not this is a fad or just a strong brand that's gaining share in a massive category?
Right. I think the big thing we look at is just the underlying macro trend in the category. So for example, that retailer we were just looking at, the one that I mentioned that went from like 110 down to 70 or whatever, their category has been shrinking. Like it definitely was a big COVID beneficiary that wore off, and now the whole category is eating shit. Actually, both the retailers we were looking at were like that, right? One was in furniture, which is kind of a well-known space that's really subject to consumer discretionary earnings. So when times are good, furniture does well. When times bad, it eats shit. So you saw that in this case, like almost perfectly lined up with macro headwinds. I think the more we see it aligned, like where their revenue is tied to macro very closely, that's something where we're a little bit hesitant to touch it. Just because you're not really paying for the company and the quality of the company, you're paying more to ride the trend.
Yeah, I guess. And then, it's like how, like, then you have to dig into like how sustainable is the trend, right?
Exactly. And I don't want to bet on that. So
no, yeah. Like, yeah, the cold plunges are like an interesting example because like, I don't know how big that market is now. It's probably still like under $1 billion if I had to guess.
it is
Well,
way
maybe
under $1 billion.
Yeah. So yeah, I mean, like, ultimately, like, I think Olaplex, like, it just like they would be fine if they just weren't public. Like, so what's like your,
Because it's still a great run, right? I mean, they started in 2014 and they're doing crazy revenue. They've been profitable almost the whole time, et cetera. That's a really good company to own over that time period, right? But like you said, public markets really fickle.
This last quarter was their first ever net loss. Um, at 12 million. Um, so I honestly, I don't know the story well enough. I mean, I dug through a lot of this stuff. There's nothing tangible. Like they cited like a little bit of inflation for the gross margin headwinds. They tried raising their prices actually in the face of that, which I think just sort of accelerated like the revenue drop off. Because they weren't really the bee's knees and they're trying to raise prices. And so, Unilever bought K18. I think it was Unilever. And so I'm sure like there's some distribution headwinds that they face just from like a competitive standpoint.
Because you were saying that retail is where they were seeing the most margin compression or revenue.
Okay. Yeah. Like, yeah. So, they had in their professional channel too. Look at this. So like in the second quarter of 22, the professional, which is like salons, not barbershops probably in this case, but like basically salons, 105 million in quarterly revenue, growing 33% year over year. 4Q24, 31 million.
So Drew, we have Olaplex, which kind of ate shit. They lost the product lead that they had. I don't want to say they fumbled it. Again, great outcome for a company that only started in 2014. But at the same time, something like Hims just continued to compound and grow just a crazy rate. Probably, would you think like that's probably the best all-time D2C brand?
I am confidently on record that Hims is the best D2C brand ever. Partially because it's not really a D2C brand. It's really just like an exemplary application of the D2C business model. And I think it just comes down to category, right? Like I'm definitely, and I'm curious what your take is. Like I'm probably more in the camp of like, and this is not hard and fast, but like D2C is a business is a channel, not a business model.
I agree with you.
Okay, cool. Yeah. So like, however, I think in the case of Hims, it's the perfect storm, right? And so like I've written extensively about like, okay, like why did D2C like get so overvalued? And it's because honestly, like when it works, like that shit works, right? Like you have like high margins, like recurring revenue, as long as the working capital is managed in like a decent fashion, like the balance sheet stays nice, and like there's just so much to like about when it works. The problem is it almost never fucking works. So basically, Hims is in this like perfectly sticky category of effectively, I don't know, healthcare, I guess. Like, I mean, that sounds like it's some beauty, some healthcare, some this, some that. Basically dick pills, and like hair loss pills and like shit that like people like are gonna take every single day, right? So I think, on the one hand, you have like Olaplex, which is like kind of this, I guess at the end of the day, it was kind of a fad. That sounds like a little bit of a strong word because like we said, it's still a very strong business and I would like to take it private. But on the other side of the spectrum, like you have this like like a new school distribution node effectively for these like old school treatments. Like Viagra has been around forever.
So what is the moat? Like if we're going to talk about Hims moat, what do you feel that moat is? What protects their revenue, their margin? Well, their margin more than anything, right?
Supply. So like this is like why GLP-1s were such a huge tailwind for them and part of the recent run up is because Hims, and this is like kind of the slogan that I use for it, is like it's like the ultimate like modern distribution system for modern medicine. So like essentially like because they finally got access to GLP-1s because there was a shortage, Hims is the number one beneficiary of some brand new technology because you can go on the fucking internet and buy it from like a doctor or whatever.
Right.
And it's insane. Like it's never been done before. Like you used to have to like get in your car, like go to the doctor office, like get a prescription, like have them fill it, and then like so
is nobody else doing this? Like why is nobody else offering GLP-1 via the internet?
No, they are. Like Roe, is like a direct competitor to Hims. They didn't really have the brand. So like I think I was going to answer the question in two parts. The first one is the supply, but the second one is the subscribers, right? So it's just like a scale moat of like, okay, like if I subscribe to Hims for my hair loss medicine and then like there's this brand new amazing GLP-1 product and all I have to do is click add to cart and it's going to show up to my door 3 days later, it's kind of like, why?
And there's a real trust
that?
moat, right? Like I probably don't want to buy that stuff from a brand that I don't really know. Like, I mean, so much could go wrong. It's kind of scary if you think about buying stuff on the internet. I think that plays into it too, right?
Yeah, I mean, it has to. Like, I think like the whole upcoming of that category was kind of like discreet packaging. Like you could buy a boner pill and like nobody would know that you were buying boner pills. Yeah. Like it's totally playing into like the insecurities of basically men. I mean, there's some like women stuff too, but it just comes down to like they have the best products, and it's not even like it's like they're making the best products. They just have access to the best
It's literally the
products.
same stuff everyone else has.
It's the same stuff everybody else has. So that's box check number one. And then box check number two is like they on their earnings calls, and like a lot of the strategy has to do with like personalized treatment. So they basically just like personalize it to you, and like it's kind of custom, and like, you just pick and choose what it's like. It's literally like shopping on like the website of like Jones Road Beauty or something. Like if I want this makeup and that makeup, except it's like things that I need every single day. So like it just comes down to like the category that they're playing in, and like I invested in that company like not a lot of money, but like in 2021, I bag held for like 4 years. I recently bought more before the run up just because the founder CEO was.
That's why you're drinking Spindrift and I'm sitting here drinking protein chocolate milk. Discount version from Costco. Wow. Okay. Must be nice. Must be nice being a Hims billionaire.
When he started tweeting like potentially racist stuff, you should have bought Hims because CEOs only do that shit when they're crushing.
That's a bull market sign. That's when you want to get involved. That's when things are going to rip.
That's literally what I did. Like I bag held for 3 years, and then I doubled down when he did that because I was like, "There's just no way this guy's that tone deaf," uh, which I think could be probably a whole investment strategy in itself. Neither here nor there. Yeah. So they ripped from, I don't know, like $10 a share to like 70, which was crazy. I mean, I tried to sell some of that on the run up, but I do think their business model and their category is perfect. I think it's probably going to be like a Lululemon type market cap at some point. And at the end of the day, I guess kind of like what you were saying earlier of just like it's kind of just products, and like how often can you replicate products, and like in drugs, like it's kind of easy to replicate. People should really, and then like the subscriber aspect of it, which I think is a little overrated. But
why do you think it's overrated?
As a financial modeler, do I really care the number of subscribers that you have? Not really. I care how many of your customers come back. And the more subscribers that you have, the more customers will come back. However, they're also coming back with a discount. So there's gross margin contraction in the subscriber base. And as long as there's like recurring revenue, I don't really care if they're subscriber or not. The way that I look at like cohort retention curves is like sure, like I'll look at the subscribers just to like see like the growth trend in subscribers because that's like a leading indicator for like overall retention. But what I think is important is like identifying companies that just like turn on the auto subscribe, right? And then like a year later, like there being a class action lawsuit, but they have really good retention, and look at all my subscribers. It's kind of like, no,
who's done that before? Who's a good example? Like recent,
I don't know.
Recent. You don't know?
I'm not ready to name. I'm not ready to name names.
I haven't seen anything recently, but okay, cool.
Yeah, I mean, it's just like it's kind of like subscribers are kind of like a hacky.
Fabletics got in trouble for something like that, right? Fabletics. Their main thing is that you had to become a member to see pricing, and then I think it's like auto subscribe after it was, and then they got in trouble for that. But it's so weird. Like it would give you an automatic credit each month is how it worked before. This is like 2 or 3 years ago. Then I think they got slapped with a lawsuit because the way it worked is you become a member initially, you just get a discount, but then afterwards they just keep hitting your credit card every month with like $25 credit. Super weird program. Obviously they've scaled really well, really big company. But it's a little bit weird, right? I've never bought clothes on a subscription basis like that. I don't know if you have, but super weird, and they got slapped. So sorry, there's my fun tangent.
I'm an investor, and I'm looking at it, and they're bragging about all their subscription stuff. But like then I look at like the overall customer base, and like the ones that don't subscribe like never come back. It's kind of like, okay, well, how many people are actually going to subscribe to this thing? Like,
right? Is it more of a marketing hack?
Yeah, totally. Like people do it all the time, and like it can work. It does work oftentimes. I am more interested in like modeling basically like repeat behavior and like a much more aggregate type basis. I think it's important to analyze subscriber trends. I'm not saying totally ignore it. And I've actually with some of the stuff with Iris, I've recently conceded defeat to this notion because everybody else thinks the opposite way of how I think with that. And so I'm like, fuck it, fine. We can build subscriber analytics into the platform, which we'll do. But like we started out saying like, don't come to us if you think that your subscribers are like the end all be all of your business.
I do like that it reduces variability a lot. Like you kind of like volatility, sorry, more than anything, regardless of how you
Yeah.
acquired them.
Yeah. I mean, definitely predictability. And Hims definitely has that. I mean, I guess like Olaplex probably doesn't. I mean, they don't talk about it. So it's like, and do you think that just comes down to like the category? Like, I mean, they're similar categories.
Yeah, I think so. And I think there's more of a benefit. Like it's easier to switch your hair care product, like your shampoo or something. Personally, I used whatever my mom bought for me. And then I went on to buy basically that from the store. And then I switched to whatever my wife bought for me. So it's like, that's my cycle as a male. I just switched to whatever's like kind of sitting around. And I used Olaplex for a while until I found out how expensive it was. Then I was like, whoa, I'm going back to the horse shampoo. Like, what is it? Horse and tail, mane and tail or something?
How
Like
much
that
is a
stuff's like
bottle of Olaplex?
way too much. It was like $40 or something. I'm like, holy shit, this is for billionaires. I'm not using that. So now I leave my wife's stuff alone. I use my own horse shampoo shit. Way cheaper, way better. But yeah, I mean, that's the way I look at it, right? Versus something like what Hims is selling, where there is a trust level where if I'm moving to a different supplier, do I know that they're quote unquote legit, right? And I think that's like when you look at Row or something, they definitely don't have the same brand that Hims has. And they're pretty large now. Like Row's quite chunky, but Hims is definitely way bigger. I think that's why it's been so difficult too. I think it requires a lot of investment to replicate their moat, which is why you don't see a billion little competitors eating up their market, which is the thing you commonly run into in consumer, right? You end up with like a lot of downstream small brands doing like 10 to 100 million a year, just ripping off of you, eating into your market share. You've kind of seen it with Lululemon. Obviously, they've still done really well, but like Vuori just ate up the men's side of that, right? Like they just totally coasted off the wake that Lululemon created, and they just slid right into like the men's side of the business and just dominated it.
And is that just like the innovator's dilemma, or like what is like the phenomenon that drives that in consumer specifically?
I don't know. I think it just depends on the business and the nature of the moat, right? In Hims' case, they just have a really, really good moat that's so hard to replicate. And like you said, it comes down to category too. How likely are you to switch? Maybe very likely, maybe unlikely. It just kind of depends on the specific category. I know that's why people are really bullish about deodorant for a while. Like apparently the odds of switching off the branded deodorant that you use are very low. So once you're there, you're kind of in.
Yeah. I was talking to one of my bigger friends like the other day, and they mentioned the deodorant wars that are kind of going on because after Procter and Gamble bought Native, which to me was like, was that 2016?
This was a long time ago, and then that other brand bought Schmidt's, right?
Yeah. And so like, I guess, and this is the question that I asked him. I was like, is that how long the cycle is? Because they bought it 10 years ago and now it matters, you know? And so like, I guess like that, you know, Native has just absolutely crushed it. Unilever's kind of feeling the hurt. There's rumors that some other, you know, players in that space, like Dr. Squatch, for example, they just did a transaction with Summit Partners a couple of years ago. So like, it's clear that Summit wants to flip that one, right? What do you think? Like, where do you think it stops? Like, is it just consumables in general? Like, can I be loyal to like a durables? Like, I do think, you know, I've written about like Shark Ninja and stuff. Like, there's plenty of products to buy from them. Like, it's not like those companies don't have like repeat purchasing, right?
That's a good question. I don't know. I think it just totally depends on the brand, category, etc. Like, you'll see a lot of jewelry brands will end up with pretty heavy, like surprising repeats stretched out over a long period. We just made a minority equity investment in a profitable men's ring company called Patrick Adair Designs that has strangely good repeat, but it's stretched out over like 2 years. So you don't actually see the repeat come in for like another year or two, but the repurchase rate is good. LTV is good. It's really odd. I was kind of surprised to see that. So it just depends on the specific sub brand, what type of product you're selling as well, right? Like if it's higher end, you can sometimes see that where it's more stretched out and repeat versus like fast fashion-y kind of jewelry that you would pick up at like one of these kind of stores you'd see at the mall. So it just depends.
There's a lot of companies that like don't have high repeat that are like able to actually reach like pretty good scale. You know?
I mean, Ridge is a good example, right? I remember Sean, when I was at Sean's office one time in Santa Monica, he pulls up Lifetimely. And I was like, holy shit, you're doing 9 figures and using Lifetimely, and kind of shocked. It was just like an app. And anyways, it just made me laugh. I thought they'd have like some crazy BI solution. This is maybe 2022 or something, 2021. Okay, 2022, I want to say. And their repeat was not great then. And I think he's posted with the exact numbers. I won't say it, but I'm sure if you Google it, it'll show up. But, and they've obviously crushed it, right? Just on a first purchase basis, more or less.
Yeah, and it just comes down to like, it's just a high AOV and like a massive market. You know?
Actually, you know what? On that side, do you know Roman from Peak 21, Roman Khan? he did a little talk, and he was talking about how some categories are just more word of mouth than others. And he specifically mentioned baby products and things that moms buy. And we saw the exact same thing. So you could see a company that was not really that well run, but you would see really good growth, really good EBITDA, just because the category naturally has a lot of word of mouth referrals. And it's because moms just like to talk to other moms about baby products. Just totally a thing. And you'll see that in specific categories.
It's absolutely genius. Like, I think I said this to one of my private equity friends the other day. My number one learning after having looked at probably at this point over the last year, more than 150 brands, some good, some bad, some big, some small. The number one objective is basically just getting mom's credit card. If you can do that, whether it's like a men's product for like the kid, or it's like like the baseball lifestyle guys, like they freaking crush it, right? And like they're obviously very public about how well they're doing, because it's like a little boy's, like, I guess, like, I don't know, backpacks and apparel and whatever. And then, like, Cody hit like Jones Road, like same customer, like two like wildly different products, but like both mom's credit card kind of a thing, So like, it's interesting. I never really considered the idea of like the actual sort of organic tendency around like word of mouth.
So I was just complaining about an issue we had with like our manufacturing production flow or something like that on Twitter. And then guess who slides into my DMs? One of the very slick founders of Fulfill, Sharoon. And I'm like, is he just pitching me again? What's going on? Because we looked at them before. And it was actually this perfect solution that allows you to automatically edit orders, like run scripts and stuff that our ERP at the time did not. Actually, most ERPs don't let you do. And I was like, this is weirdly perfect. And then he goes, I'll just fly out there. Don't worry about it. And so the guy shows up, and then he's giving my my co-founder a tour of an adjacent manufacturing facility like a few days later. And we're like, we need to switch to this. That's never happened to me with an ERP. We've used all the big names. I'm not going to name them here, but we've used them all, been pissed off every time where the salesperson completely misleads us about what's doable. We get there, like, oh yeah, you actually need to pay another like 40 grand in integration fees for that. That did not happen with Fulfill. So we've had a really good experience. And I've never impulsively moved an ERP at the same time as we moved our production operations. It was way smoother than I thought it would be. And I feel like because we had a way better ERP going into it, our operations launch in Mexico was probably like 4 or 5 times easier than it should have been.
All right. Moving on to the next segment, and my personal favorite. And for all of our first time listeners, we are doing Mehtab's tactics at the end of each episode. So here we're going to spend, I don't know, however much time we feel like, getting one particular tactic from Mehtab here that's going to be a very hardcore sort of financial / operational thing that everybody can kind of work on in their business. So today I think it's going to be understanding the cost of lenders. So I'm going to kick it over to Mehtab, and we're going to unpack this one.
Cool. Let's rip through it. So I think you've used a bunch of various lenders, right? At your last few companies. I think you guys looked at like MCA, kind of more normal private credit funds, bank lenders, et cetera. I think the first thing that you really want to understand is, what is your true effective interest rate? A lot of people look at something and they're like, I got a 10% interest rate. It's like, no, dude, you don't. Like,
rugged. You're being rugged.
You're being rugged. Like, the MCA lenders, so let's look at like a Clearco or something like that. Typically, they're making a pull every day. So you're not actually being loaned that amount of money because they're making pulls every day. You're paying them back on a daily basis. So you're not actually being loaned that amount of money. And you have to factor that in. Once you do factor it in, you're looking at like a 30-something% interest rate on the low side, up to like kind of 40, 50 even. Anything you want to add to that on the MCA side?
I've been a very public advocate for the MCA. I think... No, there's nothing to add. I think everybody should know that. You should be aware of that. The only reason that I'm okay with that is because it's unsecured growth capital that is overnight. Like the alternative, if you wanted like, and we'll probably get to this, but like if you wanted a cheaper, facility, basically, like the cheaper one's still going to be 18%, and it's going to take 6 weeks to get. So like, everyone should know that MCAs are expensive, but they're expensive for a reason. So no, that's a good summation.
They're fast, and your ancillary costs involved. I think what I want to dive into this hack is just understanding all the ancillary costs of whatever you decide to go with. And whatever you decide to go with is okay for you. Like, I don't know what's right for someone listening to this specifically, but are you okay with a personal guarantee? No personal guarantee. If you're not getting if you are okay with personal guaranteeing something, you should go through the SBA because you'll get the lowest interest rate. You'll get something ridiculously low with that, which is really cool, right? Other ancillary costs of compliance, like paying for audited financials. How much time will the C-level team spend putting together reports? Depends if they're using Iris or not, right? That'll impact that. Covenant compliance and how that changes the way you operate the business. Do you want to just explain what a covenant is for the uninitiated?
Yeah. So basically, like if I'm the lender and Mehtab here is borrowing my money, let's just say I give Mehtab $1 million. We may have a variety of covenants on that deal. One of which is like commonly called a liquidity covenant. So like liquidity covenant might say, hey, Mehtab, you can have my $1 million. But you must always have a minimum of 500 grand in your bank account. If otherwise, I'm taking my money back. There's performance covenants like an EBITDA covenant. So you might say, hey, like I'll lend you this $1 million. As long as you have at least this level of EBITDA over a trailing 12-month period. It's basically just like I said, a guardrails effectively for like an agreement, like a credit agreement.
Yeah, and I'd say like the thing you want to watch out for is a lot of the private credit funds will give you a lower interest rate. And you're like, oh, cool, I'm paying 14%. But then they have really tight covenants and they know you're going to breach the covenants. They expect you to breach the covenants. They're not going to seize your business or anything because they don't care. Like the business is just too small. No one wants to come in and operate a $30 million business. Like with the founders, it's going to implode. But what they do want to do is charge you more for breaching the covenants. Like you breach a covenant, they're like, oh, you know what? Now I have to charge you X. And suddenly it adds up and you're like, holy shit, I basically paid 18%, or maybe I even paid 20% because I breached all these covenants, which were really like impossible to actually meet unless you sat down and you modeled your business out for the next 12 months, fully understand everything. You're someone who runs like a really tight 13-week cash flow model and further out, right? Like you drag it out, you understand the seasonality in your business, and that's how they get you.
Yes. The best deal for a lender is one where they get paid and they don't really actually have to lend to you. So like I see this all the time in like asset-backed lending, like revolver lending, like the Dwights, the Assembled Brands, like the Rosenthals, like those types of players. Like basically what happens is like we're going to give you an advance rate on your inventory. That advance rate is like 50% usually, basically. And then like for a really high growth brand, I might sell all my inventory and I might not have, an ample amount of inventory to kind of, satisfy that advance rate. Then I fall, quote unquote, out of formula, right, with my revolver, and I actually owe my lender money. Meanwhile, they're charging me for breaking the deal. And so I'm actually paying them, principal back, and I'm paying them fees. And by the way, there's also monitoring fees and unused fees. So if I pay it all back, then I'm actually paying them more because I'm not using it. And so like, the sort of sticker price APR is totally bullshit. And like,
Yeah.
The MCAs get a bad rap because like you said, it's 35% compared to 12%, but that 12% is really 42% and it's a, all asset lien.
Yeah. And you'll have not crazy, but you'll have like a lot of associated fees sometimes, right? Like someone might charge a diligence fee. They might want to throw the legal costs on you. And those add up. Like we were doing a very small leverage buyout one time, and the fee that the lender wanted just for the diligence side was low six figures. And again, most of the time they'll roll that into the loan, but they basically just, like you said, they didn't actually loan you anything for that. The diligence fee is kind of bullshit. Yeah, exactly. They're just charging you because they can charge you. So be careful.
Tell us about warrants. How about warrants?
Yeah, warrants. You'll see some warrant coverage too, where they basically they'll have some sort of equity or equity-like exposure, and they'll have the right to sell that equity at a predetermined valuation or something like that could kind of juice their internal rate of return. And, the math is pretty simple. When you're looking at a lower middle market lender, they want to hit like an 18 to 22% internal rate of return. How are they getting there? How would they possibly get there if they're lending to you at 15%, right? The math doesn't work. And the math does work when they have all this juice on top. And that's where they really get you. So my advice, high level, make sure you understand what you're buying, fully understand the product, fully understand the implications. If you don't, I have a free blog article. Just Google it. It'll show up. Just dives into how to understand this. Maybe hire a lawyer. I probably wouldn't rely on a lawyer too much. I'd probably go to maybe a friend in investment banking or something similar. If you're a larger brand doing 50 to 100 million a year, it might be worth just paying someone for 4 to 6 hours just to kind of walk you through everything and make sure you really know what you're buying. What's the product you're getting?
Yeah, I mean these credit agreements are 60, 100 plus pages. Like the lawyer's got to go through some of it, but at the end of the day, like there are two types of lawyers, and they're not always that helpful. So I would definitely agree with your advice there. I think it's all like this weird game of like, and this is like kind of, it's like my frustration, but also my fascination with Wall Street is like, how do we just make everything as confusing as possible so that we have like the advantage, basically, like when push comes to shove.
Totally. And that's what they rely on, right? Like that's how this deal works, is they're basically hoping they can kind of trick and confuse the entrepreneur. And that's why when you say, if you ever say, oh yeah, we're private equity backed, their terms will suddenly totally change and get way better, and they won't try to pull as much bullshit on you. So that's kind of part of the advantage of being PE backed or whatever. Like you have a bunch of ex-bankers on your team that can look at stuff and tell you you're going to get rugged. I think they just know they can't get away with as much shit because they know that they're more financially sophisticated. They know the PE firm is going to review everything. They know that the PE firm is made up of like ex-I bankers typically, right? Is that your experience? Like, have you ever seen that before where they get a term sheet and you're like, oh, I'm Drew. I used to work in investment banking. I actually know how to read this. Like, fuck you.
I've never seen a real predatory term sheet just in the first place. So like, I have raised a lot of debt. And I think it becomes pretty clear in negotiations, like when somebody like kind of knows what they're talking about it or doesn't. So no, I haven't ever seen like a lender kind of like flip their switch on that side of things. But I would be curious, what's like the most egregious thing you've ever seen somebody try to get away with?
I think for me, it's just all these ridiculous little rules and fractions, or sometimes you'll see something where additional security can be applied and that additional security might just be someone going from unsecured to secured to like, maybe they're even like second lien or something, and it just changes, it jumps the queue or something like that. If something specific happens, we just looked at an agreement the other day where a lender that we were using tried to change the agreement when it was time to renew the lock and didn't mention it explicitly to say like, oh, there's like a PG comes into play if X happens. But it was just ridiculous. It's like, dude, we have like 8 or 10 portfolio companies at a given time. We're not PGing anything. It's stupid. So, and I called them out on it. I told them, hey, this is really stupid. We're not doing this. So,
and what's their reaction?
The reaction was they removed it right away. I just like, they know they shouldn't be doing it. I think someone just wanted to seem cool on their team and they're like, let's sneak this in here. It's like, all right, nerd.
Yeah, it's like, it's part of, it's the reason that I got into this shit is because it's all a rug. Everything is just one giant rug. And, I've made mistakes, expensive mistakes. And it's because like, a lot of like when I was 22 years old, like negotiating like these multi-million-dollar like credit agreements, like, I got rocked. And like, it's just because like these finance people, and like, this is, maybe I'm really excited that we're doing this podcast because like part of what, gets me fired up and what I'm passionate about is like unpacking these topics in a way that kind of democratizes the knowledge and sort of levels the playing field, because there's so many different things like what we're just talking about now. Like you would never even know. And like, even the first time that your lawyer says it to you, you don't really hear it. Like, the first time
like the lawyer often will be able to explain what the legalese side means, but they don't know what the practical implications are and how it practically plays out, right?
Yeah, and it's like, the first time that I learned about the, characteristics of like participating versus like non-participating preferred equity, I'm sitting there and I'm like, okay, yeah, that makes sense. But like, I didn't really understand it, right? And so like, you have to hear some of this stuff a couple times before you actually understand like, how can I apply the reality of my situation in a productive way? So I'll get off my soapbox, but I do think there's a lot of like really important topics like this for, the uninitiated audience to sort of understand, but also, for the initiated to kind of think about. And as everyone sort of goes through their business, you're going to find yourself in different positions at all times. So,
and it's hard to get exposure. I mean, like if you're running a brand, how many times are you really going to negotiate a debt deal? Like probably not that many times. It's hard to actually get like
4 times over like 7 years, maybe.
Yeah, exactly. It's like, it's hard to get reps unless you're sitting in a seat where you will just naturally get more reps, right? Like we do a lot of deals, so that's why we have reps there. That's why we see a lot of credit agreements. We look at a lot of distress stuff. So we see like, how does this actually play out? What kind of lender does this? Like, how's the bank lender play out? How's the other lender play out? Blah, 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 blah. So it's just a game of reps. Should we call it there, Drew?